We're told to diversify, don't put all your eggs in one basket. But what if the baskets themselves are now tied together? Recent groundbreaking research reveals a fundamental shift in how markets work, and it all leads back to the Federal Reserve. Today, we're uncovering the secret link between Fed rate cuts, your stock portfolio, your Bitcoin, and that safe haven, gold. Let's look at the data. This study from NYU and University of Minnesota shows that before March 2020, the correlation between Bitcoin and the S&P 500 was basically zero. They were separate worlds. But in March 2020, the Fed held 2 emergency meetings and slashed rates to zero. Overnight, the correlation exploded, increasing by nearly 2,000% intraday. This wasn't a slow trend. It was a structural break that has persisted ever since. The big fear is that a crypto collapse will infect the stock market. But the data says the opposite is true. Using advanced models, researchers found that stock market volatility Granger causes crypto volatility. A shock in the S&P 500 causes a significant and lasting ripple in Bitcoin. But a shock in Bitcoin, it has no significant effect on stocks. The risk contagion is a one-way street, from Wall Street to crypto. So, who's the mechanic that wired these markets together? Institutional investors. This Coinbase Premium Index tracks institutional buying pressure. It shot up after the 2020 rate cuts and crashed when rates started rising in 2022. Institutions, sensitive to cheap money, started treating crypto as just another risky asset. And gold? Its relationship is more complex. It can sometimes move with Bitcoin, but often acts as an independent safe haven, especially during geopolitical or inflationary turmoil, making it a crucial part of the puzzle. Okay, so what are the actionable takeaways? Diversification is harder. Your diversified portfolio of tech stocks and crypto may be more correlated than you think. Watch the Fed, not just crypto news. The biggest driver of crypto volatility might be the traditional stock market, which is driven by Fed policy. Gold is your hedge. In this new era, gold's traditional role as a non-correlated asset is more valuable than ever. Follow the smart money. Pay attention to institutional flows, as they are the ones sinking these markets. The rules of the game have changed. Understanding these connections is the first step to making smarter trades. What do you think about the Fed's power over modern markets? Let us know in the comments below, and subscribe for more data-driven breakdowns.